And David says there are bullish strategies and there are bearish strategies. There are also neutral strategies and there are speculative strategies. Which option strategies are best used during periods of extreme volatility? Market swings, market movement, things of that nature. All right. Well, I didn't have time to put together a full slide presentation on this. His email was sent at about 4 o'clock, and I actually didn't see it till about 4:10, unfortunately. But that's quite all right. We'll be able to address this very well. So, extreme volatility, swings in the market, swings going on different ways. What do? Well, what does increased volatility give us? Well, it gives us increased premiums. We see higher options premiums. This benefits the seller. It may hinder the option buyer because you realize you're overpaying for something, paying extra extrinsic value, time value, that could decay against you quickly if the market doesn't meet your expectations or do what you want. Higher extreme volatile markets, of course, give us increased risks. Wild swings in shorter bursts. Is it enough to profit in either direction? I buy a straddle, I buy a strangle, I'm looking for a U-shaped profit and loss chart or a V-shaped profit and loss chart. With the increased volatility and increased cost, is that enough to make a profit, up or down? Or is it enough to profit regardless of direction? Selling a straddle, selling an out-of-the-money strangle. Is the movement too much to where I'm entering losses even though I've got the enhanced premium? Iron butterflies, butterfly positions that have a high potential return, a low potential loss, but a very low probability of even coming close to that high return. Don't worry, we'll show the profit and loss charts of these strategies I'm just mentioning off the top of my head, it seems, in just a few moments. And the increased unknown. Timing now becomes much more essential for management, taking profits, moving positions, and adjusting positions. It also increases the risks of overreacting. Is this profit enough? I made the right choice. I've got a 30% profit of what I max expected. Is that enough? Should I close now or should I wait? Oh, it went the other way. Oh, now it's back the other way. I'm only at 25% profit. Should I close now because I missed the 35% profit? We've all been there. We've all seen that. We've all done that. Okay? So, this being said for David, let's go ahead and pause the screen. We're going to navigate over to the Power Options suite of tools. And we're going to take a look at some of these ideas and some of these concepts, in addition to using maybe some securities that just came in from live questions from JB and from Robert related to what we might expect in these situations. All right, so let me go ahead and show the screen here. Here we go. Now we're over on the Power Options main suite of tools. And let's start here with the VIX. The VIX is currently at 1507. Dropped a little bit, about 30 cents today, about 2%. The VIX, of course, measures volatility across the entire market. Let's just go ahead and click this here. We're going to go to the stock research tool, or the index research tool. Just want to remind everyone that every index on Power Options, when you're looking for the search by symbol, all of the indexes are preceded by a dollar sign. So you've got $VIX, $SPX, $NDX, $RUT, and so forth. Let's take a look at the chart real quick. Isn't directly related to David's question, but it kind of is. So we are seeing some movements, some extreme movements. We were down here. We talked about this 2 weeks ago on our Friday session, how seeing the volatility, or the VIX, excuse me, and we did it back here too, down in this 13 and 12 range. Those are kind of the good periods where I might consider buying a call on the VIX, which I did here, bought some calls here. Actually, it was around here, and got out here. And then I bought some more calls around here, and we had that discussion. Got out of half here, got out of the other half here, missed this big spike up to the 2150, and now we're coming back down. Now, of course, we overlay this with SPX. This is a broad-based index. We'll just use SPX. So we're going to compare it to the S&P 500. Let's just go ahead and draw the chart. And not seeing too much movement, of course. That's going to be shown in this sort of mustard color here. But with some of the dips, that's where you see it moving up. And then sort of the recovery here, we see the VIX coming back down to where it is. That's naturally what we expect. So with these different movements that we have, earnings surprises, earnings failures. We've got Alphabet announcing a dividend and strong earnings. We've got Intel falling about 10% today at one point because of poor earnings. We see some retail stores closing. Other retail stores are surprising with their earnings and moving up in price. When we were at that peak a week and a half ago at about 21.50, again, what was that going to do? That was going to benefit the premium. That was going to benefit the option sellers. But we still had some wild swings. So we think to ourselves, what's a good strategy to get premium and be far enough away? Think of an iron condor or a short strangle. But moving to the outside wings, is that enough to where the upper break even and lower break even is not breached? An example that we had, a question that came in from a power option subscriber, my apologies, earlier today, was related to NVDA, NVDA. And I think these guys got a big jump the last few days due to other reports that came out. So it's up 6% today, and it was up 3% yesterday. And yeah, it's at 877. It was as high as, I think, about 885, 886 today. But I want to go ahead and link to the option chain. And let's go back. I apologize. Let's go back last week before, when the VIX was around 21.5. Let's go back to April 18th, day before expiration. And what I want to do when this comes up, now I apologize, the history might be a little bit slow, and that's only because we're uploading all of today's closed data right now into the tables, so it's going to take a little bit longer. But I want to go out to, let's just go to next week. Let's go to May 3rd, expiration. Now, at the time, the stock was at 846.71. And I'm talking about a short strangle. What is a short strangle? Well, I'm going to sell similar to an iron condor that we just took a brief look at, where I'm combining a bull put credit spread here with a bear call credit spread here. And I want the stock to remain in this range so all four options expire worthless and I keep the net credit. Well, a riskier version of that, in my opinion, using the same probabilities, using the same delta, if you want to look at it that way, same range out of the money, would be the short strangle position. I'm selling an out-of-the-money put and an out-of-the-money call. Increased volatility, so I should get increased premium and have a much wider upper break-even and lower break-even. Yes, that looks like a little professor with a high nose, I understand. But that's what the short strangle position is. Now, back when the video was at 846.71, on or around April 18th, when the VIX was in its higher levels, away from that 13 to 14 range, above into the 18, 19, 20 ranges and so forth. What were we looking at for 2 weeks out in time, 15 days remaining to expiration? And what I might look for in an iron condor position or with a short strangle are selling positions that have a delta of maybe 0.3 or less, meaning I'm going out of the money. Yes, there's my delta. I apologize. So in this case, to be safe, I'd probably be looking at the 892.50 premium, which is trading at 14.20. And at the same time, on the put side, might have been looking here at about the 815. Yeah, let's call it the 815 for a midpoint of 16. So I'm just, that was the 892.50, correct? Okay. Very good. Now, let's go ahead and just build that in our custom spread tool. So we're at NVDA. The May 3rd expiration. We had our 815 put, and we had our 892.50 at that time, 14.20. Oh, sorry, wrong quantity. Let's just do one to keep the math simple. We're going to sell the 815 and sell the 892.50. Okay, so we got 14.20 and 16 roughly. Oh, no, that's backwards. The 815 was the 16, my apologies. And this is 14.20. All right, now, risk and rewards. This was, remember, a 2-week out series for this position. Similar to been an iron condor, but I would have bought the outside wing to receive less premium in. The max profit is about $3,020, but remember, we're essentially in a naked call at the 892.50 strike and a naked put at the 815 strike. So the monetary requirement, of course, is very high. The return, 1.8%, that seems small, but that's based on full margin requirement. Your broker would probably give you a break on that. You'd probably have the ability to only do 25 or 30%. 40 or 50%, depending on what they are. Now, in this scenario, you're looking pretty good. We took in that premium of 30.20. And right now, let's just add it to the portfolio real quick so we can see the view. We'll just put it into, doesn't matter which one, let's just call it preferred structure. Why not? We'll insert that there. Date is irrelevant, but we'll just put that in at the 19th or the 18th, I think we said. Fantastic. Now, let's go ahead and submit that. And we see here that the original expected profit was 30.20. Right now, with the movement in the security, we're only making 918 or 30.4%. And we still have some time to go, don't we? But it looks like a profitable trade. We took in the higher premiums based on the current volatility at the time. But even though the stock is below our short call strike price by about 15 points, because it moved up 50 points today, it moved up about 20 points yesterday, we're only making about 30%. We have the potential to make the full profit, of course, of $3,020 within 7 days if the stock remains between the strike prices. We tried to take advantage of volatility selling. We're at the 892.50 call. What happens on Monday if this goes up another 30 points? Oh, we're at 900 now. We're still in a profit zone, but we're pulling away from the maximum loss. And on Monday, we're still probably going to be only here, maybe a profit of $750, $762. And what if it goes up another 40 points after that? Well, now we're going to start entering the loss area. And of course, if it really takes off, we're not expecting it to hit 1,000, but if it does, the risk is overly inherent. Now, as a practice, what I want to do is go back to the option chain again, which I removed and I should have kept open. But I want to go back to the option chain once more and go back to that historical date of April 18th. Because I want to see something else. I want to see the expiration of today, following the same pattern and procedure, saying to myself, if I used a 0.3 delta out of the money for only a 7 or 8 day out trade when the volatility was high, what strikes would I have been taking? Again, let's go to our delta column. My apologies. And here, let's be fair. All right. Okay, it's the 880 call at 293. I'm sorry, delta of 293. Our price, 1020. Nope, 985 is the midpoint. My apologies. 985 is the midpoint. And our 0.3 delta on the put side. Looks like we're going to, same thing, 820. Not too bad. 60-point spread for just a short strangle position. With a price of midpoint looks like 1068. Now let's just call it 1070. Okay, so now, why am I doing this? Because now I want to take the same look at that position if I just went 1 week out in time, using 0.3 deltas. Where would our positions have ended today? We did choose the 880 call, and we were using the, no, that doesn't, I think I wrote down the wrong number. I think it was the 820, right? Yeah, 820 put, my apologies. There we go. And at the time, we could have sold both in one contract apiece. Our 880 call was at 985, and our other strike, 820 put, was at 1070. And those are the 0.3 deltas. And this position, a 1.2% return, looks like it would have worked out well. However, at one point today, you would have been in a panic. And the reason why is because you've got a naked call and the stock breached the 880 strike at 883. And at one point today, I saw the buyback of that call at 1540. Now, the put was essentially worthless. The buyback cost was 1540. So you still might have made around a $5.10 profit, or about 25% of what you expected, because of the swing in the movement. Now, why is this important? Because a lot of times you hear the things that you have to take advantage of implied volatility by selling into the premium. We want to, believe me. We all want the best bang for our buck. When we're selling premium, we want the high implied volatility. What does high implied volatility account for again? Increased premiums. We want to be selling. Increased risks, wild swings in the market. Increased unknown, short bursts, back and forth, day by day that we saw this week in the market itself. Are you far enough out of the money to make it work? In this example, we used the 0.3 delta for 1 week out and for 2 weeks out. At one point today, you would have had to close the position for fear of being in the money and assigned early and end up potentially being short shares of NVDA at 880, strike price of the option that we sold. And an opposite thing, we'll take a look in a minute on Roku. JB mentions a question related more to married puts on Roku and a stiff decline. But would that have breached likely any short strangle we had, even with 0.3 or 0.2 deltas? Absolutely. That's the case. So we do want to sell into premium. You think. A short straddle, no protection, naked call, naked put at the same strike price. The short strangle we just illustrated. A little bit more protection, the iron condor, where I might be selling those same out-of-the-money options, but I'm buying an outside leg for protection in case the stock exceeds expectations, or the butterfly position, an all-call, all-put, or iron butterfly, where you're selling at the money again to get that inflated premium, but you have a known risk on the wings. Not necessarily a low risk. Low risk depends on your allocation and how many contracts you trade, but it is a known risk on the position. But are these necessarily the best strategies to enter? Now, we see we would have made the full profit on this position in a higher volatile market on April 18th. Oh, shoot, those got cleared out for me. Let me see if it still records. And I'm sorry, this one here is preferred structure. If I just broke the system. I did. Okay, so we were on the video. We were going to sell. All right. Okay, 880 call. Oh, it did record it. 880, 820, 985 times. Sorry. So this is for the 1 week out trade. My apologies, folks. I did have it in there. It did record. I thought it wasn't going to record properly because I cleared it out. All right. And now, again, we know that at this point, we made the full $2,000 if we held on. Honestly, you would have closed this and only made $500 or 25%. So our 1 week out trade in a highly volatile market, selling into inflated premium, would have garnered about a $500 profit, maybe a little bit more. For next week, right now we're only at $918 of profit in the position, which is 30.4% of our expected max return. Now what do I want to do? I want to reverse it. Inflated volatility, April 18th, about a week ago, that higher range. Just showed 2 examples of selling a strangle out of the money for 2 weeks out and a strangle out of the money for 1 week out, and what we would have seen today based on when we would have closed it when the short call went in the money. What if we did the opposite? On April 18th, instead of buying or selling into a high protected strangle, quote unquote high protected strangle with a high probability, what if I bought something around a 0.45 or a 0.4 delta? Meaning that even though the prices are inflated, that's my 1 week out. Okay, this is the 1 week out. We'll do the 1 week out first. 0.45 delta, what if I bought even though it seems overpriced with higher volatility, what if I had bought, make sure I'm looking at the right column. I wasn't, I'm sorry. So 0.4, we'll use the 0.4, we'll use the 862.50. I'm sorry. What if we bought the 862.50 and that higher implied volatility for 1605? Let's just call it that. We're using a 0.4 delta for the buy now. And 0.396. Okay, we'll do the 835. Pretty inflated at 1668. So in this case, I can tell it's going to be a loss just based on the numbers. But once again, let's go ahead and build that structure. Let's go back to NVDA. This was the 1 week out that would have expired today. We would have bought the 862.50. And we would have bought the, I'm sorry, strike that, reverse it. 862.50 call, and we would have bought the 835 put. There we go. Okay, let me clear that out. There we go. We're going to buy one apiece. And what did we pay for that 862.50 call? 1605. And 1668 for the put. Let's just call it 1670. All right. Now we had a total cost of 32.75. We're in a big loss zone here, and we can see that where we would have profited on the short strangle in this movement. But let's go ahead and add it to the portfolio again. Keep it in preferred structure, one contract apiece. Sorry about that. There we go. All right, so now the long strangle, we're at a loss of 1780. Where we know we would have had a profit of 500 on the short strangle, fantastic. We know we would have had a profit right now of 918 on the 2 week out short strangle, with the potential to still make 3020 with no further movements in the security. But this one probably got to a point, not, I'm going to say honestly, not where it's at break even, but this loss was probably below $1,000, with it being up at 883 today, closed at 877. We would have seen a profit, we would have seen a value here of almost $22, $23 here on that 862.50 call. Let's check that real quick. What was the high today for that call? I'm going to link to the call research tool. All right, now let's see. High. Current session high was 2130, so I was close. All right, so at 2130 with our initial cost basis of 3020, yep, we would have lost only $900 on that position. I'm sorry, that's the wrong one. There we go. Let me refresh that. There we go. So 3275. I'm sorry. So we would still have been down 1200. I was looking at the wrong one. All right, but now let's go out 2 weeks as we did before on the option chain. I'm going to use a 0.4 delta again. We're at the 870. And it looks like we would have been, yeah, I'll use this one, the 835. Yeah, it's a fair comparison. 835 at 2385. Okay. So this is 2 weeks out. Still has time remaining on our position. We're going to change our options once more. Look at May 3rd. 7 days only to expiration. We need the 835 and the 870, right? Yep. All right, and we bought one of each. And for the 835 put, 2385. And the cost for the 870 call, 2158. And here we are. We're still in the dead zone. We're still in no man's land, respectively. We had a higher cost of $45.53, about 50% more than the 1 week out straddle, long strangle. I'm sorry, long strangle. But where are we now? Once again, we'll add it to the preferred strike. Transaction date doesn't matter because it recorded my prices, so we're just going to disregard that for the time being and speed this along. All right. And now this one is at a loss as well of 916. But I have some more time. We do have a profit of 1929 here on our long call. We do have almost the full loss. Well, not really, but 65, 75% loss. Now, all this is pointing towards that I'm advocating to the short strangle positions as a way to trade in implied or markets of higher implied volatility. But that's not the case at all. Okay, because the risk to reward is potentially too high. Although it worked out in this case, we moved up 3 or 4% the other day. We moved up another 6 or 7% today. We've seen about a 9% movement. Intel had about a 9.5% drop today because of earnings. JB's question coming up is related to Roku and says, if I was trading in Roku and the stock drops 35% overnight, what would happen? If I am in this structure and the stock moves 35% up or down, where would we be? Well, remember, we were looking at this position back on April 18th when the stock was at 846.71. So a 35% movement on NVDA from 847 or so would put us at a movement of about $300, $296 roughly. So in that case, $296 plus 847, that'd be at 1143. Is this a strategy I want to be in for something that moves 35% up, roughly $300 up from where it was at 846 or down to 546? Or would I rather be in a position such as this, even though I overpaid into these options for that long strangle or potentially the long straddle, with something bigger than a 9, 7, 8% movement in the security? Why I went through this exercise with this much length, even though just focusing on short strangles 1 week out, short strangles 2 weeks out versus long strangles 1 week out, long strangles 2 weeks out, is that volatility did occur. I wouldn't say we're an extreme volatile market, David. We are in a moving market, but it's not extreme volatility. This is nothing like we saw back in 2022. This is nothing like we saw back in 2020. There's some change. There is some movements. There is some volatility, and there's a pullback, a correction that was expected, by the way. And we were expecting, and we talked about it on previous webinars when we started seeing these sell warning signals, is that eventually we're going to expect to see a correction of 5, 6, or 7%, regardless of outside global impacts and everything along those lines. Okay, that's what we expect to see because it was overbought. It was overrun. 52-week range. Look at that, $1,200, roughly. $1,220, as a matter of fact. So a correction of a couple hundred points, 6, 7, maybe even, okay, let's just call it maybe 10%. It's not really 500, but it was close at the bottom, but not really. It was only 300, so it's only 7% correction. That makes sense. What doesn't make sense, of course, now is the change in the market discussion. Where are we at now? We only had a 1.6% GDP, and coming out this week. That caused the market to have a little big hiccup earlier. Then we had some positive earnings come out, and we saw the market kind of react to that. Then what did we have? Well, we had this fear of today. The PCE, the other inflation index, was higher than expected, but the market seemed to kind of shrug that off a little bit based on these other factors that we're seeing and sort of a renewed optimism. Also down here below, this is just for the S&P 500, but you can see down below, we're at that point, broad-based index, where we're coming back up to the 20-day moving average and the 50-day moving average and SPX and other indexes. And this sort of pattern we talked about before with some of the married puts and when we might look to roll down the put to take profit on our stocks individually, but also here, after this decline, we're seeing this bottom in the MACD and sort of a rising up where we're hoping to see a crossover. Now, weekend events, we don't know what's going to happen, but it could happen. And we could start seeing what we want for the crossover and back into sort of a bullish trend and a strength trend going forward. We talked about this discussion a few weeks ago, a month ago, when we talked about buying calls and buying puts. What is the best strike price to buy? Well, that depends on your expectation of the security going forward. If I only expect 5%, 6% movement on a security, then I'm going to need to buy calls that are slightly in the money or at the money. If I'm expecting to see something much wider, if I'm expecting to see a big movement going forward, 10%, 12%, 15%, the profit that I'd see the most on a long call or long put is going to be slightly out of the money. Volatile market. Does that change the game? Well, naturally, as I said, we want to be selling into the higher premium if possible. We all want more bang for our buck, right? We all want to see more premium coming in than is normal to help us increase our annualized return from time to time. But it comes with the risks. Is the movement enough, if you're the seller, to stay out of the money enough where you're still making a profit? We saw with NVDA since April 18th with about a 7 or 8% move, that was the case with a 0.3 delta. But if you saw a 15 or 20 or 25% move, you would have had losses on those positions. Hindering the buyer, that 7, 8% movement on NVDA was not enough to benefit the buy positions 1 week out or 2 weeks out long strangle in a volatile market. But if you have a Roku, something along those lines that suddenly moves 15, 20, 30%, this is the profit and this is the major loss. And remember, when we talk about short strangles, with no floor, no known risk on the position. Wild swings and shorter bursts, needing the profit movement for the strategy. I can have some movement here on the strangle or the straddle, but I don't want too much. I need more movement here in a more extreme volatile market, which is a higher possibility. Is that enough to profit regardless of direction? As you saw, timing becomes more essential. I only have a small gain of 30% here. We would have only had a $500 gain, I'm sure, because we would have closed the short call at least on that short strangle for today's expiration because of that movement. Or risks of overreacting and trying to fly quickly every time you see a profit on one move, adjust, go up, go down, same thing. That's where we'd run into trouble. Okay, that's the fear of the volatile market. What do I do personally in a volatile market? Well, you guys have heard me talk distinctively over time about how my portfolio is represented, that 50% of the portfolio, my trading portfolio, roughly 45 to 55%, is in the married put positions, protected to single-digit risks. I have 2 out of the 4 positions I have open are bulletproof with no risk right now. About 15% is in bull puts or bear call credit spreads, directional positions with that 80 to 85% probability. Not the iron condor, not playing both sides. In more volatile markets, what I tend to do is lighten up on the account size of this because this is something that can lose 50 or 100% of what I invested in the position. So this might drop down to 7%, 7.5%, maybe even only 5%. Because of market uncertainty. The premiums are helping me, but again, just as we saw, is that probability I'm looking for? And by the way, that delta, 85% probability, that delta is at 15, not at 30 as we were looking at before. But is it enough? Do I convert to a bear call? Yeah, if I see the market sentiment tool go into sell warnings, I might convert this 7% now that's lowered up in volatile markets to bear calls instead of bull puts. 10% or so might be allocated to diagonal calendar spreads, positions I'd like to trade as a married put, but I can't because of the cost of the underlying security. I need to use leverage, so I might trade that as a diagonal calendar spread. But again, in volatile markets, I might lighten up on this, or I might even buy 1 or 2 puts against this position to protect the calendar spread. Changes the whole dynamic of the strategy, but is there for a short term. Now, we've had some strong earnings. We've had some surprise earnings this week on some big names. About 2 to 3% of my portfolio might be invested in what I call the lottery tickets. Even though they're inflated, but the long straddles or the long strangles, typically for me, buying strangles, Ernie prefers to buy straddles if I'm not mistaken, using the same strike, but on stocks that have earnings. But it's only 2 to 3% of my portfolio. It's only a few contracts on a couple of different stocks. Why? Because the potential of implied volatility crush and seeing a 60, 70, 80% loss is there. This is just to catch the surprise. It's a lottery ticket. I win on this. I have some extra money, take the family out to dinner, so on and so forth. And then about another 3 to 5% of the total portfolio, as we saw on the VIX chart. When I see the VIX drop down to those ranges at around 13 now, at around 12, I'm going to start buying calls on the VIX. And this is to hedge. I don't need to hedge the married put portfolio. That's already hedged to single-digit losses. I'm in control no matter what the market does. But this is to hedge against this 15 or 7% and this 5 or 10% that's in these spread positions, leverage positions that can quickly go to a 50, 60, 70% loss. So that if the market does drop and these bullish strategies I'm in become threatened, then I get some value of profit here to help hedge the losses I might take for closing out, rolling, or adjusting those positions. Okay? So that's the game. And I know I didn't give you direct answers because there is no direct answer, in my humble opinion. We want the premium. We like volatility because of the increased premium, but it comes with increased risks of wild swings, shorter bursts. How wild are the swings? Is that enough to take advantage of the premium with low delta and low probability while still being able to see profit on the position without having to close early or overreacting? Paying into that increased extrinsic value or time value. Need a bigger movement one direction or the other. It still comes down to the anticipation of the movement of the underlying, the movement of the volatility, and the movement directionally one way or the other for those sell positions, short straddles, short strangles, iron condors, iron butterflies, call butterflies, or put butterflies, to stay in the profit range. A wild swing too much one direction or the other, you're in the loss zone very quickly. With the buy side, you saw that as well. If I see those wild swings on the securities of 20, 25, 30%, I'm going to be looking very happy, even paying into that extra intrinsic or extrinsic value. I'm sorry, extra extrinsic or time value. I'm sorry. But if I only see a 7, 8, 9% move, whether it goes 9% up one day, comes down 3% the next day, goes up 5% the next day, then drops 7% the next day, I probably saw potential for some profit here on the call side or the put side with a long strangle or a long straddle. But unless timing is correct, I could see a 70, 80, 90% loss of what I paid in the position. I got to take the profits when they're available on one side or the other if I'm playing a volatility play and playing a volatility market. Now, this is a simple discussion. As complex as I maybe have made it to you, this is a simple discussion. Why? Because I'm not going to go into all these concepts of ratio back put spreads, ratio back call spreads, 5-to-3 ratio spreads, gamma neutral, implied volatility neutral, delta neutral with different ratios, contract sizes, 3-leg spreads and 4-leg spreads. That's just way out of bounds for, I think, David, what your interests are and what you're looking to play. I know you're looking to profit in volatility. I know you're looking to protect in volatility. But going down that rabbit hole, which I said I was going to avoid at the beginning of the presentation, is not what we want to do because it gets too complex and you're constantly having to adjust those positions on almost not even a daily basis. But in these types of markets where you're seeing swings up and down, it's almost every 2 hours or every 3 hours, you're extending contracts, adding more contracts, selling contracts to keep in that gamma neutral, rho neutral, which we talked about last week lightly, delta neutral positions, playing into the premium of volatility while keeping protection and low risk. It's challenging. It's time consuming. And it increases the risk of overreacting to every little bit that comes out. So I'm not going to delve into those. Okay, not going to jump into those complex strategies, I should say, beyond the complexion that we took in. So, I just reviewed my portfolio. Why did I review my allocation for my portfolio? Because even in volatile markets, I'm keeping with that same structure. I approach it as mastering the strategies, having the protection in the bulk of my portfolio with the limited risk married put positions, using the income generation from the bull puts, calendar spreads, diagonal poor man's covered calls, and adding extra levels of protection by buying calls on the VIX or puts on SPX when we're at the low volatility for the risk of an increase or change in movement. Back in 2022, by the way, when we had wild swings in the market, and even 2020, what I started to do was look at, oops, sorry about that, folks, that popped up out of nowhere. But what I started looking at was out of the money straddles and strangles about 45 to 60 days out in time on SPY. And in the volatile swing markets of 2022, where every time, Powell spoke, we saw a swing one direction or the other, and then it came back. After the melt-up market of 2021, those positions were very profitable. And, we'd manage it a different way. We'd roll up the strangle, roll down the strangle when we saw a certain percentage. That worked out extremely well. But that's also when volatility was jumping up to the 30s, then coming back down to the low 20s into almost the 17 range, then bouncing back up to 28. It's a much more volatile market than we're seeing today. So based on your question, I don't know if I consider this an extremely volatile market. I consider it a moving market, but it is not as volatile as we've seen in the past, as 2020, 2022. But it's not as calm as the markets we saw back in 2017 either in those cases. So just as another discussion, that's just where I like to keep my positions. It's where I like to keep my structure. And I will move from bull to bear strategies when I see the market sentiment tools shift on us. And right now we're staying in a neutral position. We updated on April 26th. I will lighten up on those leverage portions of my portfolio. But I'm only using a small percentage of my portfolio in things such as long straddles, long strangles, credit spreads, debit spreads, and calendar spreads, or even maybe just buying calls on something that pops up in the news or buying puts, because you can lose 100% of what you invest into those positions, 100% of the margin required, or a large percentage of the margin required in a short strangle or short straddle if the market exceeds the volatile movement you're expecting, even though you're trying to sell into that higher premium. Now, the example I showed completely proved my point wrong, but I did that on purpose to sort of illustrate the point that it does depend on the extreme volatility of the market itself, David. That if I don't see the swings that I anticipated, only a 7, 8, 9% movement, for example, on NVDA, overpaying into the long strangles and potentially the long straddles won't be profitable. But if the movement exceeds my expectations, that in a 1 week or 2 week period, I see a movement of 25, 30, 35%, those short strangles and those short straddles, iron condors, iron butterflies, call butterflies, or put butterflies are going to be near the maximum loss. Well, for the ones that have a known risk, such as the condors and the butterflies, my apologies, the strangles and the straddles are going to have significant losses due to the leverage on those trades.